On behalf of the Graduate Student Assembly, I am delighted to welcome you to a very special fireside chat. My name is Allison Morrison. I'm a student in the evening MBA class of 2025. And as part of GSA's executive board, we've organized this speaker series to connect graduate students with our many amazing alumni and faculty who are shaping the futures of their respective fields. First off, great turnout today, so thank you guys so much for being here. I see also some special guests here in the audience. Shout out to Mark Philippe, another McCombs Evening MBA alum and the founder and CEO of High Sign Brewing here in Austin, who is joining us here today. So today, we are incredibly fortunate to have Bill Gurley joining us. Bill is not only a McCombs alum, but one of the most influential venture capitalists of our time. As general partner at Benchmark Capital, he's helped build transformative companies like Uber, Grubhub, OpenTable, Stitch Fix, and Zillow. He's also known for his industry analysis and thought leadership, which he's been sharing for more than 15 years via his Above the Crowd blog, and for the past year on BG2, a podcast he co-hosts with Brad Gerstner, where they break down the most important developments in tech markets and investing. Moderating today's discussion is Professor Patrick Badolato, who the McCombs students in the audience will know from our accounting and financial statement analysis classes. And if you've taken his classes, then you're also likely familiar with Bill, as his thought leadership and investment frameworks are regular features in our class discussions. Professor Badolato's deep familiarity with Bill's work and his own expertise in accounting and corporate governance made him the perfect guide for today's conversation. So thank you, PB, for agreeing to moderate our discussion today. Would like to thank also the TEMBA and full-time program staff, venture fellows, and full-time graduate business council for their help in promoting this event. And lastly, thank you so much to everybody here for your attendance and enthusiasm, even during finals and the holidays, and also the thoughtful questions that you guys submitted in advance, which will be guiding much of today's conversation as well. So with that, please join me in welcoming Bill Gurley and Professor Badolato.
Well, to kick us off, Bill, first, as Allison mentioned, I've appreciated learning so much from you, from your podcast, from your Above the Crowd blog, and for everyone in the audience, if nothing else, this is just the start of a conversation. You know, definitely double click, as Bill and Brad Gerstner like to mention. Think about following up on all these things that Bill has done, the massive amount of thought leadership he's offered on Twitter, through his blog, through the podcast as well. So absolutely appreciative of this opportunity. We'll get started. I'm going to, is there a way to change that feedback? Or can I do anything differently?
There's an echo.
I can turn you down a little bit. There's just a little bit of delay before it comes out the house.
Okay. That sounds a little bit better. We'll see. I'm guessing it might be the same for Bill, but that's good. I want to start with a quote from Charlie Munger. I've used this in class, those of you who've taken the class, and Munger offers, when people tell me that they learn from experience, I tell them the trick is to learn from other people's experience. We're talking about a very simple idea of just figuring out the standard stupidities and avoiding them. And I want to use that to launch into the first question that I'd love your insights on. You're known for having one of the best batting averages in VC, incredible track record. But what contrarian truths or longer run aspects did you see in the companies that others or collectively larger markets missed? And then to just add on to that quickly, what hype cycles were you able to correctly identify and avoid?
Yeah, thank you for that. By the way, one thing, just especially because of the courses you teach, when I left McCombs it was a long time ago, 93, I spent 4 years as a sell-side analyst before I became a venture capitalist. So I worked on Wall Street covering the PC industry. So anyway, just in case I think it's somewhat relevant because it's a different type of work than venture. You know, one thing that's great about that Munger quote, internally at Benchmark, we say good judgment comes from experience, which comes from bad judgment.
I like that.
But I do think that learning from others is much better route to go. I was very fortunate to join a group of 5 founding partners at Benchmark who had been in the industry before I had. And they had a very amazing equal partnership structure. So I got those learnings from them. Mm-hmm. But the other way you can get those learnings is just to read voraciously, like in whatever category you're in. And that type of question is not one frequently answered. Like, would you walk up to, so Mark's a friend of mine who helped set this up. He's in the brewing business. Would he travel to St. Louis and visit a local brewer and say, what are the 10 things you wish you knew when you started? Those are the kind of questions that can keep you out of that type of position.
Yeah.
And it's not something that everyone does.
Yeah.
So moving on to your question about contrarianism, there is an interesting dichotomy in the venture industry in particular. I'm a big believer in contrarian thinking. There was this amazing piece of work written by Howard Marks, who is someone everyone can learn from. All of his writing's amazing. But he talked about the fact that in order to make a lot of money, you need to be contrarian and accurate. And a lot of people think that being accurate alone is good, but in a fully competitive market, those returns get whittled away. This is often found in a stock that has a really high valuation, and you have to ask yourself what's priced in, like what assumptions are priced in. The reason I call it a dichotomy in venture is I think I've made a lot of money being contrarian, but occasionally a wave comes along, like AI right now, and what would be contrarian in AI? Oh, I don't like AI.
Yeah, good point.
You're gonna be out of the market, right?
Yeah.
And so you have to apply it at the right time. For me, I think there's a saying my partner Matt came up with. He says we don't predict the future. We just see we just see the current time very clearly. And there's an essence in venture of needing to be about 3 years ahead of the curve.
Right.
But if you're 7 years ahead of the curve, you get a 0. And if you're late, it doesn't work either. And so it's really what's right in front of us. And for me, it's a combination of like thinking about, okay, these technologies have fallen into place. What's possible in the next 3 or 4 years? I can remember when I met Open Table, they were in 3 restaurants. And so, and the idea was this is going to be a network effect. You're going to be able to book. Everyone's going to want to book at the same place. That was the discussion as we entered into that, and, I can remember one day there were 20,000 restaurants on this thing, and that's the kind of bet that we were making. Like, could that play out? Uber's very similar concept. In fact, I wouldn't have been in Uber if it weren't for Open Table. I was looking for something very specifically, like what's the next Open Table?
Gotcha.
But once again, okay, now this technology's out there. Could this be possible? You see, what was happening early in San Francisco with Uber, and just say in your brain, could you extrapolate this around the world? And then, today it seems like an easy thing,
right.
But it that's how that played out.
Yeah. I want to offer something for the audience there, but I think the title of the Above the Crowd post is Missing by a Mile. It's your 2014 take on Uber. And your point, it's easy for all of us to say, look, Uber's a success for these reasons, but Mark, Bill's making those points. A decade before today is the amazing way to do it. And if you have the time, it's the specifics of kind of how you challenge the idea of the growth rates of the total addressable market. So just to harken back to your days as an analyst, I've always admired that, your ability to kind of think big picture and know where things are going, but also, talk about some of the
there's
financial
a very
aspects.
famous, I would encourage you to read that as well. There's a very famous NYU professor, I forget his name right now.
Motorin.
Yeah, and he had written a post that said Uber would never be worth more than $4 billion. And luckily today, I think it's 120, 130, something like that. And unfortunately for him, like the mistakes he made were common. Like McKinsey made the same mistake about the cell phone market, which I put in this thing. But he was using the taxi market as max TAM. And I had data he didn't know, which was in San Francisco, we were already 20x bigger than the San Francisco taxi market. At the time he wrote it. So.
Right, yeah. Fascinating. I think that leads into our next questions. And some of that stuff, like if you've taken financial statement analysis, we've covered a little bit, but On this one, you've been vocal about the importance of unit economics, and you and Brad Gerstner consistently, and I really like this aspect in your podcast, the need for companies to get fit, to focus on that. In today's market, what fundamental metrics, and this one I think might not be specific to VC, but take it however you want. Today's market, what fundamental metrics do you think founders and/or investors are still getting wrong? And then on top of that, back to the Munger quote, what common metrics or standard stupidities may distract us from focusing on the fundamentals that ultimately matter most?
Yeah, let me come to unit economics second. The number one thing that I see founders miss is stuff that comes straight out of the first book they have you read in business school, or one of them, which is Michael Porter's 5 Forces. And they just really miss the 5 forces analysis, and they go into markets where there's too much supplier power, too much customer power, and you just can't win. There's just no way to win. And that piece is so seminal because of that. And I think through this my entire venture career, but I can't tell you how many people just kind of leap off into a market where there's going to be 3 customers. Right. And no matter what you sell them, you're never going to have good unit economics. Yeah. It's just impossible. Right. And so anyway, he wrote that forever ago, but so important. On unit economics, the number one thing that happens, that I see happen, and the venture industry is remarkably cyclical, but so if you think about it this way, in the venture industry, people go from glass half empty, half full, half empty, half full. When they're in a half full mindset, they'll fund anything. They just forget about unit economics. Yeah. So they do a lot of hardware, they do a lot of clean tech, they do these things that where atoms are heavily involved. Right. And some people, look, Elon's putting rockets in space, but you can't look at it one off and say, I'll put rockets in space. When you're moving atoms around, it's just harder. If you have a low gross margin business, it's just harder. Yeah. And people forget about that. They forget about it. The other thing that can happen, and I think this is going to happen with OpenAI and Anthropic, is your true cost can get there's a really dangerous thing that happens when time and cash flows are widely separated. This can happen in fintech, giving out loans as a business, because you don't know your recovery rate for 20 years, 15 years. And so it's very hard to know the unit economics in a situation like that. But in the AI space, Microsoft and others are giving free server capacity. Well, not free, they're getting equity for it. They're trading equity for server capacity. And so those companies are running on a day-to-day basis with a high COGS, but they don't know it because they're not paying cash for it. And my suspicion, having lived in the venture industry for 25 years, is your brain gets warped in that environment. You don't think about, oh shit, we should be depreciating this cost through here. And one day, that freebie may stop, and then all of a sudden I am paying cash for a cog that's not there today. Yeah,
I've used that, not that example, but that's one of your episodes, but I think it was episode 5 when you guys talked about a similar thing with stock compensation, but to your broader point, how easy it is to think, well, those cash flows are later, so they're never coming, as opposed to no, think about all your actual costs, no matter how we're currently measuring them, they're still there. Yeah. So the other one I want to mention there is, and I don't remember the date of this one, I apologize, but why companies should end 10 times revenue, I think, was the above the crowd post.
Those are the keys to the 10x revenue.
Yeah, keys to, that exactly. Appreciate that. But it's and that front and center is the Michael Porter stuff. Just to double click on your first point of the importance of understanding that context of the industry. And again, to your credit, he's put all this stuff out there. We all have the opportunity to have read that for decades. It's fascinating.
Yeah, the venture industry. I've said this out loud in public, so I'm not going to get myself in more trouble than I'm already in. But I've declared that if the VC industry were judged on their financial acumen from a 0 to 10, it's a 2 or a 3, like the sophistication level. and they frequently use revenue multiples. But what I did in this post was I took like the top 500 tech stocks and laid out their revenue multiple, and it's just like one of them's at 0.1 and one's at 30, and there's a curve. Like there's no reason that's what you should do, and you subject yourself to remarkable arbitrage by some of the cleverest founders out there. Who, if you tell them, I said this when the SaaS business was getting overfunded. If you tell somebody that you're going to pay 20x revenue for their business, they'll figure out a way to make that happen.
Right.
And you can grow revenue like you can. It's easy to grow. We always use the analogy of selling dollars for 80 cents, but like you can grow revenue as big as you want. Like if you give away something below cost.
I think we've had a version of that with Blue Apron in class of the explosive revenue growth, but not thinking about both the unit economics and then to your point, just the choices to discount and do promotions that
we had a very high profile failure in now I can't Webvan.
Yeah.
This is 20 years ago, but customers love the product. It had the highest NPS score in the world. Like that's the other thing. You have to combine all this stuff. Like if you have an INPS score because you're giving away something for free,
right?
Then that's not durable.
I was going to ask that question. You kind of answered it, but you can add to it if you want. Which was, I wanted to start that off with learning from the experience of others, but this one I wanted to go right at you here, Bill. Which is with respect to your own career, what's the biggest mistake you've made and have learned from? And then how did it shape your future decisions? And then if I think most importantly, how can we learn from that? Like, how can we sit in this room and learn from your wisdom? But
I'm not sure you can learn from it. The biggest mistake I ever made is there's zero competition for this. I met Larry and Sergey when there were 25 employees at Google and had them present to my partnership, and we didn't follow through and try and invest. I don't think that's going to happen to anybody. But what did I learn from it? Well, in venture, and a lot of people talk about this in venture, but you have asymmetric returns. You lose 1 times your money, but when you miss out on that, you miss out on 10,000 times your money.
Yeah.
And so we had a saying, what could go right internally? We never sweated a zero. We didn't do like case analysis on why we made that mistake, but when we miss big winners, we talk about it frequently, because of that reality.
Can I just push a little bit more on that? Like, so when you had that conversation with missing out on Google, can you recall any of the things you talked about as an identifying, and I don't know the time.
I've been over this in my head about 1,500 times. So yes, I have remarkable clarity on that day.
Yeah.
There's one of the interesting things about venture is, and this is true of a lot of what I find to be really interesting problem sets. It's a nonlinear, multivariable problem. Like it's a complex system. There's no rules. If it were just simply apply these rules, then everyone would do it and everyone would make money. And so I've often thought about it as you develop a set of pattern recognition, which is enhanced if you're working with a partnership because everybody has their own. And you have like 10 loose rules that you apply when you see a company. But a lot of the times when you make a great investment, it's because you decided to relax 1 or 2 of those, which is a really like chaotic framework to live under. There were a lot of negative signs in the Google case. Yahoo had fallen from 82 to 10 as a public company. Excite was in bankruptcy. These were other search companies, right, at the time.
Right.
Larry and Sergey both wanted to be CEO, and they were PhD students at Stanford. It's not a great, co-CEO, PhD students is not on the checklist positive. And they wanted a really high price. And I don't know if we could have closed it. We didn't lay chase. The interesting thing, and the part that probably bugs me the most, is 2 of the very best venture capitalists of all time, John Doerr and Mike Moritz, did the deal. So they had a superior mental framework in that situation, and broke a lot of rules. You know, they took, another thing was because they split the deal at a really high price, their ownership was much lower than they traditionally get in an investment. But they knew to break that rule, you know, at the time. It wasn't because, a lot of people say it was because you didn't know how it was going to monetize. We had already met Overture, which was this paid listing ad search thing that Bill Gross had built in LA, and we were like, oh yeah, we'll just do that. Like, that's what you'll do. Like, that wasn't the issue.
Right.
Yeah.
But is this correct, and correct my ignorance, please, but you have unwritten rules. You have to know those rules without them being written, and then you have to be willing to figure out strategically which ones to break in each situation.
It ain't easy.
Right, exactly. Let me just
imagine. I mean, like, imagine the people that invested in Tesla, so like Steve Jurvetson, and like you know, that is a heroic set of decision making that likely violated most people's entire rule set.
Right, 9 out of 10 or whatever. Yeah. All right, let me jump to this one.
And I guess makes it contrarian, which is why the return is so high. Yeah.
We were chatting about this before you came here. So in your episode 19 of the BG2 pod, you were chatting about the idea of, and I think I have this right, the single most important in the VC landscape today was what I will categorize, and correct me here, is that there's more of a push towards the 2%, the fee from assets under management, instead of the 20%, the fee or from returns you generate. And when I was listening to that, often when I listen to your podcast, I'm like, fist pumping because I'm super excited about what you're saying. But I have this question, and you can take this however you want, which includes ignoring what I'm saying here. I'm just curious if this is broader and more inclusive of most professions. And have we, society, pushed more towards transactional than transformational? And then as an action step, how can we, and I'm going to say business schools, professors, students, all of us here, how can we think about inspiring or encouraging the next generation of leaders to be more transformational than transactional?
That's a lot in all that. The firm that I worked at, Benchmark, has been consistently committed to very early stage investing. And it's not uncommon to give 2 people on a PowerPoint $5 million. That by its very nature has kept our fund sizes small and have put us in a position, and now that I'm not doing new investments, I guess I can kind of just declare achievement of feeling very good about the work that I did, and that the fiduciary I was working for, the LP, they made a lot of money, but I made my money when they made money. Which is, so he's referring to the common hedge fund or VC model is 2 plus 20. You get 2% management fee, and people don't know this. It's 2% every year. It's a lot of the money. And then 20% of the ups. And some firms get a little more, some get a little less. There's been a trend in venture recently. I thought it was the zero interest rate thing that caused it, but it's sustaining beyond that. So there's something else. But there's a lot of loose money, which always sounds like a weird concept, a lot of loose money. But there's a lot of loose money. When interest rates were zero, I actually got invited to this dinner in Omaha with Buffett. It was a pseudo-political fundraiser, but we got to ask him one question, and I said, with zero interest rates, all your DCF models blow up and there's chaos. And he said, you betcha. So, and so I thought that's what was going on. But then the AI wave, I guess, just brought so much more enthusiasm that the money's so available. And what's happened is, and I've been told there's a Wall Street Journal article coming Thursday to talk about this contrast. Many of the peers of Benchmark have taken their fund size up 10x. So their assets under management, and they've declared themselves multi-stage. And then there's a whole nother thing, we could talk about this for 3 hours, where, and so they've got so much money under management, and there's a belief in network effects and power law dynamics that is now pervasive. And so if you're excited about an industry, you're emboldened to find the best company in that industry and give them money at whatever price they'll pay. And I was in New York last week, and I met with Josh Kushner, who runs Strive, who had just raised $7 billion. Incredible young investor, very, very sharp and smart. There's a big profile of him in Fortune recently. And that's the game he's playing. He did the last Stripe round. He's putting money in Databricks right now at $50 billion. And he's preempting the IPO market. Like a lot of these late stage guys have decided that it's easier to corner the late stage market than to corner the IPO market, because Morgan and Goldman won't give them the allocations they want. So they're just preempting, and these companies are getting delayed further and further, which has huge overall impact. And so what we were talking about on that podcast is when they raise funds of this size, I mean, it's $10 billion under management. That's, $200 million a year in management fee. I don't care how big your staff is, that's a lot of money. Yeah. And a lot of people have accused the PE industry of this, the private equity, where, the amount of money that's coming out of the management fee is so high, you could theoretically become indifferent to whether you ever create any return or not. Right. And everything gets messy. And one of the hardest parts is if you talk to a very large LP, one of the largest is here in town, the UT endowment, but the window with which they can assess these venture funds, because so with this delay of the IPO market, the venture cycle is going from it used to be liquidity average 7 years from a company's first investment. It's going to 15. Right. And so the window you need to evaluate whether a venture firm's any good or not, 2 cycles, 30 years? You get beyond the career of a single GP. It becomes near impossible. And so the correction mechanisms for the cycles are really hard. Right now, in the period, I always like this, my new thing is pre-LLM. So in the pre-LLM, let's call it half decade, there were all these unicorns created. Right. There's over 1,000 private unicorns. Some people estimate that the average growth rate, which we should talk about because it ties into unit economics and pragmatism, is below 10%. And across the universe of endowments and foundations, these companies represent a huge line item on the balance sheet, and they're all wrong. They're all way too high, and none of that's played out yet. Right. And it's a mess. And it's just a mess. And with the IPO market non-existent, M&A, at least under the current administration, has been non-existent. Right. There's going to be hell to pay when this plays out. The corrective mechanisms take so long. So you ask the question, what can we do about it? Yeah. They've already committed the dollars. Right. And the way a lot of the hedge funds fell in love with the VC contractual arrangement when they found out how it works, because a hedge fund gets paid 2%, but it gets marked to market. So if the stocks all go down, the amount of fee they make is less. VCs get paid a percentage of the allocation over time, so it doesn't move with the market. Right. And so they all discovered, this is way better. Right. And so there's just massive amounts of money that are stuck in these structural relationships. And the business has been historically cyclical, and so the corrections take 10 years, and we were due for one coming out of ZERP, but then this AI wave came and more money piled in, and people are getting a lot of money from the Middle East. Yeah.
So I have a question, if you don't want to answer.
So I don't know the answer. Yeah. I don't know the answer of how you fix it, because the fiduciary, by the way, one of the problems, there's too much information, but one of the problems is the LPs a lot of times get paid bonuses on paper marks. Right. And so they don't have any incentive to write these things down to their appropriate valuation either.
Yeah. So I'm going to ask that then. Do you think Do you think there's a correction coming, but then what would the catalyst be for that correction? Or do you think the structure is so unique that there's no way we could predict such a thing?
I think it's going to take forever because so this is a crazy thing that happens. So in this pre-LLM unicorn world, everyone just started raising more and more money. And believe it or not, there's a dynamic right now. It's as worse as it's ever been, where because you have these monolithic late stage players who believe in power laws, believe in network effects, if one of our companies starts to work, and this has happened in the past 6 months, despite the fact that we just did the Series A, 5 different firms will knock on the door of the company and say, can we put money in Series B, and 50 to 100 million. They just want to cram money in. I thought about it. I learned how they force feed geese to make foie gras. Oh, yeah. And they have this funnel tube that they stick in their mouth. And it sounds surreal because you're in business school. Like you're not, like how could that be going on in this world? And then what happens, and this is what happened to all these private unicorns, they're taking more money than they should. And they're fearful that their competitor's going to do it. And their competitor does it because they did it. Right. And then you end up in this situation that I lived through with Uber and Lyft, where you're trying to outspend your customer, usually on go-to-market. And for Uber and Lyft, that's customer acquisition. For enterprise companies, they build huge sales forces. And they overinvest. Mm-hmm. Instead of project 1, 2, or 3 and arguing over which one you should do, you do all 3. Right. And then you take on massive risk because you take on massive burn rate. If you're raising 200 million, you're going to burn 3 million a month. Like you're just going, you're going to use the money. And then getting back to break even's harder. But what happened with all these private unicorns is one day the money dried up and their lick pref stack, if you know what that is way bigger, maybe even than the valuation of the company. So then the board has this beautiful idea, which makes sense. Let's get profitable. Let's get to break even so we can control our own destiny. But you've been overspending in categories you don't belong in. Yeah. So you start cutting headcount, you start rationalizing, and that's why the growth rates are so low. Yeah. Yeah. And so you're stuck. Yeah. And there are so many companies in Silicon Valley and beyond that have 300 or 400 million of venture capital in their lec pref stack that are doing 100 million in revenue, growing 10%, and maybe worth 1x revenue. Right, right.
That's fascinating. If nothing else, when you walk out here, continue to, if you haven't already, get exposure to his podcast, because the visual representations like the overfed geese, that's in there, and that's just I don't know. I think you've always done an amazing job of making this stuff accessible and using those kind of illustrations. So I've appreciated learning from that. Let's switch gears a little bit here. Let's talk about where we're at in Austin. You certainly have a fascinating and unique perspective on Austin, being an alumni, seeing many companies locate here, you yourself being a part of this community. What does Austin need to do differently than Silicon Valley to build its own unique innovation ecosystem? And what can we learn from Silicon Valley to be the next great entrepreneurial hub?
So I've been fortunate enough to be invited in to try and help through the university system improve this very thing that you're talking about. I think one of the pieces, which is an advantage, is already underway and is very recent, which is just I think the pro-business mindset in Texas versus California is night and day different all of a sudden, overnight. And Abbott's very much aware of this, and people like Elon are very aware of it. And that creates an opportunity, a window of opportunity, where a lot of companies have moved here, a lot of companies. Unfortunately, historically, a lot of the tech companies that come here put sales here or customer support. Right. And that doesn't create founders, unfortunately. Right. And so what you really need are product people here. Right. And because those are the people that are going to become founders, or you need founders here. And so one of the so the big advantage is we have a differentiated pro-business environment. Like it just is. It's night and day. I could tell you about some of the stuff in California. It's just crazy.
Right.
And people are becoming aware of that.
Right.
And like not just Elon, Ben and Mark talk about it on their pod at Andreessen Horton. Like everyone's aware of it. But we have to get more founders here. And I'm hopeful that Elon's presence is encouraging on that front, and to get more of them here. I've been working with the university. This is a theory. We'll see what happens, to help launch an undergraduate robotics program. The impetus for wanting to do that came from, if you spend time around high schools, the better high schools today have a maker space. And there's kids in that maker space that compete in FIRST robotics competition. And I have a theory that the Michael Dells and Elons of tomorrow are in those spaces. And they wanted to go get a robotics degree. There was no major school that had a robotics program. So we announced this thing like a few weeks back. There's only going to be 100 cohort in the fall, and we have 7,000 applications.
Wow.
So I think that proof of the unmet need.
Right.
And then the thing I'm trying to lean on as much as I can is, what is the selection criteria so that we get the founders to sort in there. And then the last part, this one's going to be more critical, and I don't know how to fix it, but this town's just way too much fun. And it attracts people that are sorting on social experience versus work experience.
Interesting.
And I don't know how to fix that.
Right.
But, people in Silicon Valley grind. They work hard. Yeah. People in Seattle grind. They work hard. People in China grind harder than people in Silicon Valley. Yeah. And if you want to compete with them globally, you've got to be okay doing that, I think.
Right.
And
is your recommendation to close down 6th Street, Bill?
I don't know. I mean, look. There is a work ethic at all of Elon's companies that's off the hook, and some of that is in Bastrop, and some of that's over at the Gigafactory, and so it's not impossible to do that here, but it's a key part of making it work. Unfortunately, like you can't work 40 hours a week and win in the private company world.
Yeah. That's awesome. I love your comment about robotics. I'm going to take that to my 11 and 10-year-old. I think we've had those conversations with those kids, but it's just a fascinating perspective to think about. But
by the way, I was talking. One of my partners said he was at one of these robotics competitions, and he was trying to equate it to like the math club. And I said to him, it's way better than the math club because, first of all, there's creativity involved. Yeah. You're not just answering the questions that everyone else is like. This kind of a wide open, and there's a system dynamic to the whole thing. There's trade-offs, like if you make this choice, it's here versus there. And so I think it's much better at training a founder than a math club would be.
Yeah, way more practical in some ways, and then you're like constantly thinking some degree of costs and benefits, or
no doubt,
relative position of something.
I think it's great.
Yeah, you were giving a comparison in your conversation.
By the way, listen to this. I'm gonna just steal the.
Go ahead.
Because I was thinking about these high school things. I got invited to the SpaceX launch where they caught the booster, and I took my dad. My dad was an early NASA employee, very early NASA employee. And he spent 25 years in the space business. And we're at an after party after this thing, which is really lunch, on South Padre Island. And we're looking around, and young people everywhere. And this HR person was there, so we started talking to him. The average age at Boca Chica is 29, which is fascinating.
Yeah.
And it was funny because I asked my dad, was that true at NASA? He said yes. Yeah. And I found a document on the way home where my dad was involved in a special reentry problem, and he had written a report, and I found it online. And he was 26 when he wrote that.
Yeah.
I'm like, holy crap. But I found out from this HR person that SpaceX is mapping the rocket clubs at the college level and the best high schools.
Right.
And I thought, holy crap. This is like athletic recruiting. When have you ever heard of a company recruiting in high schools? Have you heard of that?
No, of course not.
But are you surprised?
No, man, I mean, because you lay it all out, and so you refer to that episode of visiting the facility on your podcast as well. And I'll be honest, as a dad of three, that really resonated with me because you're talking about your relationship with your father, and then the other idea is the age of entrepreneurs being involved in this is absolutely fascinating. But you're right; it's there's no reason why not, and I'll synthesize some of your points here. And you got a.
But by the way, they also going back to the hard work thing. I hear. I mean, I'm picking this up anecdotally, so I don't have any proof points. But Boca Chica's there's dorms almost. They're working 80 hours a week, and maybe get over South Padre Saturday night, and then the rest of it's,
Yeah. I was joking and offered, haven't we made that same conversation with the NBA that the teams that struggle the most using your basketball background are the ones where the nightlife is too good and they go to the cities that are less attractive and all of a sudden they're focusing on their craft. And so
do we
have the same challenge here?
There's this great dichotomy because we've all gotten so excited about the notion of work-life balance. When we study great athletes or musicians or chess players or whatever, or even a painter. If a ballet dancer works 80 hours a week on her craft, we all think that's glorious.
Right.
Oh my God, Michael Jordan practices more than anyone else. But when you apply it to the work environment, all of a sudden it's heretical. Oh my God, they don't believe in work-life balance. Well, it's the same shit. If you want to be at the top of your game, you got to decide whether you want to make that trade-off or not. You don't have to. There are plenty of jobs on this planet where you can work 9 to 5 and you may care way more about your family life, personal life, and that's fine too. But to think that you're gonna excel,
right,
and not grind, good luck.
Right. I want to build off Bill's last point there in this, and I'm going to in the arena. It's an awesome Teddy Roosevelt quote. Hopefully you've seen. But I'm also going to pay homage to David Senra, who runs the Founders Podcast, that I'm a huge fan of. He's recommended this. I've actually borrowed from him that you're running down a dream speech that you gave here on
the stage.
Exactly the stage. That is in my top list, not a textbook, not anything about, watch that before doing anything else in the class. And I'll offer this. You discussed the value, as you were just mentioning, and I'm echoing some of your points right now, of following our passions. And I really like your perspective here. And I'm offering this. The manifestation of authentic passion is the work we actually do on our own behind the scenes. And you specifically note, do you go home at night and study for yourself to improve your own skill set? And then you say, most people don't do that, similar to your point. So using a different phrase from Teddy Roosevelt, his phrase of get action, what would you advise we do? And I want to be very careful about this right now, tonight, tomorrow, Wednesday of this week, not delaying or putting it off or listening to something, to put this idea of professional research. And I think that's a Danny Meyer concept, but you've amplified it quite well.
Good at it.
Yeah. How do we today, right now, actionable, get action, put professional research into doing something?
So I'm working on turning that speech into a book. I've actually sold the publishing rights, and I'm way behind on writing. Haven't been thinking about it a lot more. I would say there's a symbiotic relationship between passion and continuous learning. Mm-hmm. And if you are the kind of person that does kind of incessant external learning, mm-hmm. you're very likely to be wildly successful in your field. Mm-hmm. But there's a quid pro quo. Unless you love that subject matter, mm-hmm. that excessive, what we're calling excessive learning or external learning, is going to eventually feel like a grind,
right?
And it's going to fall apart,
right?
We had this will be in the book. Don't tell anybody this part. we had me and the co-writer had a chance to sit down with Angela Duckworth, who wrote Grit, and she said that if she could go back, hers was about passion and perseverance, and she said what she's learned since she wrote it is the perseverance part can't hold if the passion part's not strong enough.
Right.
And this is the person that goes to McKinsey but never really wanted to be a consultant, and 5 years in it's like, what am I doing? And like they just burn out. Like there are plenty of amazing humans in the modern day world whose helicopter parents have taught them how to grind.
Right.
And so they can go do it for a while, but it burns out. There's a pretty cool graduation speech that Jerry Seinfeld gave at Duke recently. It was over. There's a lot of people knew about it because of the walkouts, but that's immaterial to the point, which is he used the word fascination instead of passion. Right. And I think it's easy to make fun of the word passion because it's overused and it's a cliche. And I kind of like his word better anyway. Right. Because if you're fascinated with something, the external learning, the studying becomes like innate. Yeah. Right? Yeah. But yeah, there is no, here, the really amazing thing, even since I gave the speech, it's gotten even easier to learn on your own.
Right, yeah.
I'm not kidding, you'll think I'm overstating this, I'm probably doing 50 ChatGPT queries a day. Because you can learn about anything. Yeah. I was at the last week at the Deal Book Conference in New York that Andrew Ross Sorkin does, and every speaker that's coming up, like I'm reading 5 pages of background before they start, just because then I'll be able to absorb it better. Yeah. And you can learn anything. Right. And the voice mode's going to get better. You're basically going to be able to drive your car around and study any topic you want. Right. And so the question is there a topic you care that much about? Right.
That's awesome. I want to. I think I'll move towards wrapping up.
And by the way, I especially with the younger generation, I think a lot of people say you got to follow your passion, and they scream it at them when they're 14, and they have no idea. They're like, "Can you get out of my face?" Like I'm not. And so I think it's hard. Like I don't know that everyone will get to that place where they'll find it. Something that they care about that much. There's a couple of things. There's a podcast. I love that Founders podcast because he summarizes books. But what's the other one?
Acquired, I think.
Acquired, yes. Yeah, so I talked to these guys. They're going to be in the book. Oh yeah. So, he now has his dream job, like this Acquired podcast. Yeah, I think it's number one out here.
Yeah, phenomenal.
And he didn't know at your age that that's what he wanted. And he had come up with a construct that I kind of liked, which is he creates a side hustle. So he had 3 jobs prior to this podcast popping, but each one of those 3, he did a side hustle. So he had 6 shots on goal instead of 3. Right. And one of them was he went to work at, I think, Madrona Ventures and launched a podcast. Right. So he just said, hey, do you guys mind if I do this? And they said no. And that's what led to Acquire. Right. Or,
I'm assuming this is David Rosenthal, is that, I think?
I have to look up which one of the 2.
Yeah, whatever.
Yeah.
I think so.
But anyways, if you don't know what it is, find a lot of opportunity to learn and explore. Yeah. And it's okay to take a job that may or may not be it. And if you can get in that one and learn. And another little hack that I thought of when writing the book is, every time you have to go to some social event, you don't know, like the people there, you don't know what you're doing, or you're kind of ask any older person what their career is and what are 3 things they love and 3 things they hate. Just do that writ large. Like you might find something.
Right. Absolutely. All right, I'll wrap it up with one. I'm going to call this Grounded Visionaries, and I'll kind of bookend what we talked about at the beginning. I have certainly benefited immensely from Timeless Wisdom of Charlie Munger and yourself. Let me just be honest about that too. I, in many ways, still get choked up thinking about the passing of Charlie Munger. It affects me. I always saw him as more of a philosopher than just an investor. And here's what my question is. In contrast to the way the loudest voices dominate our public spaces, here's my question for you. Who are the next versions of grounded, thoughtful, yet profound thinkers, and how can we better amplify their voices? And you've got to give me, back to your comment about Space Force, NASA when your dad was there, you've got to give me, or can you give us any answers of someone who's on the younger side, so not a Howard Marks, who again, amazing, but who's that next crop?
A lot of time, and this kind of nicely fits in with what I was saying earlier about just continuous learning. A lot of times the people that give back are the ones that are doing the learning themselves kind of at a high level. So the acquired guys, right? The Founders Podcast, Harry Stebbings at 20VC. Right. Harry started doing that when he was 18 or 19. He's now connected in a way. I don't know how old Harry is now, 24. He texted me this morning. He's connected to so many people.
Right.
And by the way, the podcast is like, what a life hack. Like you could take some vertical and go be the top podcaster in that vertical, and you're probably going to get to interview all the top thinkers, founders, executives in that vertical because no one else is doing it.
Right.
That's what he did.
Yeah.
Go just do a ChatGPT search and say, tell me about the history of Harry Stebbings. It's miraculous. Mm-hmm. And he just raised a $500 million VC fund.
Oh, wow. So on that, I actually want to echo one of your points to bring this all together, and then we have a little bit of time for Q&A.
One element that I find, you triggered something in my brain, which is a lot of times the people that end up doing that type of writing and giving back, they all read and studied the people that did that before. Yeah. I'm sure Harry's read all of Buffett's papers and he knows who Howard Marks is, even though it's somewhat far afield, and they see that, and that's how they get their own knowledge, and then they feel compelled to give it back.
Yeah, and to just emphasize that point or amplify that again, and you've mentioned this consistently today and other things, the opportunity for us to learn. I think when you're running down a dream, it's unlimited, and that was before AI, which is an awesome comment to make. How right you were.
Yeah, you had Wikipedia, you had podcasts.
10
when
blue
I
links,
did that,
basically.
And you had YouTube, but now you have this AI thing. It's unbelievable.
But I think on top of that, and I've loved this myself in listening to Acquired and Founders and your own podcast of we have this amazing opportunity, not just as the podcast founder, that's a great perspective, but as the rest of us of listening to that stuff, and you're getting, I think the Acquired guys mentioned this, they're putting 120 hours of work into each of these. They're the grinders, put it in. And what do we get? Yeah, it's 3 hours long, but it's I'm getting, 200 plus hours of these brilliant people and, listen on 1.5 speed or whatever you want to do. And that is an amazing resource that we all have access to, that there's people putting that out, charging us nothing. I got to listen to ads for a little bit.
Here's another life hack, a real quick life hack. Anytime someone tells you to read a book, find out when the book was released, find a podcast where the author went on tour, and you can condense it to 1 hour. If you love the podcast, you can then go read the book. But don't start with reading the book.
That's Founders to me. The incredible amount of value that David Center has offered. And he always says at the end, it's for more, this is his take, but I think that's exactly it. That's a 1 hour version of arguably some of the most important books written across history. That's awesome. So let me just ask you this question. I have to, selfishly. Would you endorse a class whose main mantra was read good?
Sure.
That's the tagline of my financial statement analysis class. So I think, Allison, have a little bit more time. So thank you so much. That was awesome. I appreciate the opportunity to learn from you. The thing I'll offer is we're not done. This is that lifetime of learning, that continuous learning. We should all be thinking about something to listen to after this. But I think we have a small amount of time for Q&A from the audience.
All right. There's a fast hand up.
What are some opportunities that you are most interested in right now and think are most compelling for the near future, for example, AI agents?
Yeah, as I mentioned earlier, it's hard to be contrarian when you're excited about AI because the world's excited about AI. And I've never seen, literally, I think in my venture industry, I've never seen something that's got so many participants wholly convinced that it's right. And even if I go back to the mobile wave or the internet wave, there were plenty of skeptics like within the Fortune 500. Today, the Fortune 500 is all in on AI. And in fact, one of the things that's a real problem for that pre-LLM unicorn base is if the average CIO is committing 10 or 15% of their budget to AI, if you're not in that, you're getting shrunk. And so it's just overwhelming. I think the easiest place to think about opportunities, what I would call realistic opportunities, because you're not going to prop up a mega cluster like Elon, is in vertical spaces. And the vertical spaces where I think the easiest opportunity are ones where language is really important. The LLM, not everyone's figured this out, but they're still not very good at math and may never be. And so, but they're really good at text and language and areas where that can be applied. You know, there's already 7 highly backed venture legal plays for this reason. And paralegals are already losing jobs as a result of that. But anyway, that's, there's a lot of people playing around with trying to do financial statement analysis, and like all the hedge funds have propped up their own models. Yeah. And I'm hearing mixed things, right? About whether that works or not. But that would be it in a vertical. There's a good chance that this is where contrarianism can work, and it all depends on scale, like a big venture firm. But the more discrete the vertical, the better chance you have to have the edge and be the smartest person in the room, which may be required. Yeah.
Grab another one.
Yeah, how would you compare venture firms that are within tech companies, such as Alphabet's Capital G and GV? I'm curious how that compares to the rest of the venture VC.
I haven't thought about. He was asking about corporate venture firms versus regular. Google's almost an anomaly of their own because they have 2 different vehicles and those people are fairly autonomous. At most corporations, you end up with a really crappy situation. One, it's hard to recruit GPs that are world-class because they can just go work at a venture firm and make a lot more money. 2, the CEO doesn't want you to have the kind of economics an external GP would have because you might get richer than the CEO or the CFO, and that dynamic always creates problems. There's conflicts of interest. The only great experience I had was with Qualcomm. They would be very selective and they would really help the companies, and they use their venture fund to help their platform. So they wanted you to win because it meant their platform was winning. Intel was the worst. Like, they would just take notes and then go get smart on your back. But I've never loved any of them, really, like, to be honest. The Google guys, like I said, they're a bit of a different cat. Yeah. They were actually quite helpful in the Uber situation.
I'll grab one more. You can choose, Bill.
Because
I'm biased.
I don't know. Who had the hand up first? I think
this guy in the back did.
Okay, right here.
Oh, behind him, sorry. Sorry, Aaron.
We'll do all of them, speed round.
Go ahead.
I saw a 2018 interview where you described Bitcoin as a credible store of value. Do you still...
I should have bought a ton of it, shouldn't I? My partners are, and I have not been a big crypto guy, but this guy that I've known my whole career, Bill Miller, who was one of the best investors of all time at Legg Mason, he's a massive bull and has been for some time, and he's one of the most independent thinkers I've ever met. And I would suggest that the massive deficits at every country around the world is very positive for Bitcoin. The only thing that could upset it, I would say, is if there was some technical hack that somehow unwound it. But if that doesn't happen, I think it's in a good spot.
What convinced you that it wasn't the bet? What did you see?
It's non-inflationary. and every other currency is subject to government inflation. And it's got, path dependency, first mover advantage. It's locked in. But I'm not the best person to talk about crypto. There's plenty of others that go deeper.
What should we be doing, given our age and demographics, when you're talking about high school students and robotics teams, that type of, what would you be recommending for people in our state?
I think just, don't be afraid of innovation in the edge. If something like ChatGPT or anything like that pops up, be curious and play around with it. If you're all about to enter the workforce and you're hyper knowledgeable on AI, I don't care whether you're in finance or marketing or whatever, that's differentiating. That's valuable. They're going to be like, oh, we want to talk to you, and there's no reason why you couldn't have experimented, that kind of thing. You could also watch the speech that he's talking about, because I have a lot of ideas.
The writing down a dream one.
Yeah.
That's pretty good. Yeah, I think you've seen it.
Okay. Let's do a few more.
With the introduction of NIL and collegiate athletics, I'm curious to hear your thoughts on venture's role in collegiate athletics moving forward.
I will tell you, I'm a massive college athletics fan. You may or may not know. So I woke up in Atlanta Sunday morning, and I was at the basketball game yesterday. 2 losses, unfortunately. When I heard about NIL, and I was in California at the time, and the Pac-12 really is the one that made it happen, I, in my brain, cried a little bit, because I think it could be the end of college athletics before. And the vast majority of people that play college athletics, and I'm including D3 in every sport, are not good enough for someone to pay for an advertising. And we're going to reorient the thing for 1 percentile. And I think it's going to put at risk the rest. You didn't ask that. Yes, on Friday, I guess, some PE firm announced they were going to try and buy 51% of the athletics program. To me, that's all consistent with what I feared, just the beginning of the end. My best guess is that you end up with 3 mega conferences that are, and I don't know how long the universities will. I think there'll be massive pressure at other schools to try and reclaim amateur status, or just separate. Or there's already pressure at schools like Dartmouth and Williams and whatnot, because 30 or 40% of the admissions are sports related, and there's massive pressure on the boards to just stop that. So it may kill athletics, which I think would be a horrible thing. But sorry, that's my.
So, you mentioned earlier that companies are staying private for much longer.
Yeah.
That's because of easy money, like low interest rates, or just more demand from consumers.
They just don't have to go public. Keep going. Yeah.
What repercussions do you see for the industry based on this? That funds are not returning capital to LPs. Do you think there's going to be more of a secondary market?
I think it's massively negative ramifications for the venture industry. So one thing that's happening when these late stage people are feeding, there's a name for this tube they put down the geese's mouth. I need to remember what it is, but where they're force feeding these companies, because they're prematurely coming to these companies before they even have a capital need. One of the things they're doing is they're supporting massive founder liquidity and employee liquidity. And so that's happening at Stripe, that's happening. At OpenAI, if you've been there 2 years, you're able to sell your stock, which has never happened before, ever. And one of the number one things that would encourage a founder to take a company public was to provide liquidity for his employee base or her employee base. And so now that's almost off the table. But if you're an institutional investor that owns 10, 15, 20, even 7% of this thing, there's no way that you're going to want to exit, selling to the late stage. Yeah, and it would be instead of a market where the stock trades and and you have collective wisdom, it would just be a one-off negotiation. And you wouldn't have a lot of power in that situation. And so I don't know what's going to happen. And the other thing that happens is the IRR gets pushed out because you go from 7 to 15 years, and you're getting diluted on all those rounds. And also 15 years, the average, even at a big company, the average option employee dilution is 5% a year or something like that. So you're just clipping that down and watching your ownership shrink. Yeah, it's tough. It's tough. I don't know how it's going to end. Hopefully the M&A market's going to improve with the new administration, because the big companies haven't been willing to do it. They haven't been allowed to do anything.
Right.
But I don't know if the IPO window opens up again. Service Titan is supposed to price this week, I think, which would be a first test.
I was wondering about what VC firms consider when they want to invest in long horizon projects, like, for example, innovation for energy or climate change, like Bill Gates has its own breakthrough energy fund.
Yeah.
What do they look at the startups when you don't have cash flows to elevate and revenue, let's say, 10 years away? What are the main key points VC would look at?
She was asking about VCs and long-term commitments to things like climate change. Look, there was a massive wave of solar investments about 15 years ago where everybody lost all their money. And it's tough. It's a tough business to build. As I said, material science plays are tough venture plays. Fortunately for, I guess, the planet, if you're excited about those types of companies, there are people like Bill Gates and others that have committed to trying to bring these to life. SMRs, small modular reactors, are the latest craze. Everybody's really, really excited about nuclear. Mm-hmm. I could show you a podcast where people say this is not pragmatic. It'll never make sense. It'll never make mathematical sense. There's, luckily, one of the great things about venture is, like, you get multiple tries, and some people do what can't be done. And the person I'd probably bet on building an SMR over anyone else is Elon, of course. Mm-hmm. But there are people willing to do it, and right now, capital is, like I said, it's free. There's a local fund run by Luke Nosek that does mostly these types of bets. So there are people doing it. I probably wouldn't do it. Like, I wouldn't, put it this way, if I were managing an endowment, I wouldn't put money in a fund that was doing that, just from a pure return standpoint, not any moral judgment. It's hard work. It's hard to make it work.
Want to grab one more, and then?
Okay, last one.
So you can grab whatever you want.
Yeah, no.
So in the next 10 years, AI is obviously going to have a huge impact in the way that products are built or how people interact with them. Considering network effects as a key strength at businesses that you look at, how does that change in the world of AI?
By the way, that pings something I should have said earlier. I'm very fascinated with voice as a UI. And, Gates got excited about this 25 years ago, speaking of, like, getting the timing right. And, even Siri's not good enough to be a real UI. But it looks like we may get to where voice could be a UI. That could change products immensely if you're talking to a product instead of typing. Like, it could really change things. And I don't know... Like, I haven't thought through enough of, like, which ones would be better for that or this or that. You brought up network effects. If you use ChatGPT, if you go deep in the settings, you can turn on memory. I don't know if anyone's done that. And you can see, it shows you everything it's remembered about you. And if you're doing 50 queries a day like me, there's quite a bit of information in there. You can delete stuff you don't want it to know, but... you start getting answers that you can tell. I think what they're doing is cramming that into context window, so we're using RAG. But, like, you can start to get answers where it knew what you were. And, go back and watch the movie Her, which is, I think, one of the best kind of foreshadowing movies of all time. Like I think there's an unbelievable network effect if that's how that plays out. And ChatGPT may be in the best spot for it. I think they've got a very complex cap chart thing they got to figure out. But yeah. Okay, thank you guys.
Thanks,
Appreciate
guys. Appreciate it, Bill.